The subtitle of this book kind of gives it away, if you will, Hidden Asymmetries in Daily Life. So many people who claim to be in the business of finance are in search of that mythical asymmetrical trade.
Yes.
This book is full of practical advice.
Yes.
Explain.
In fact, it tells you what's both morally and commercially acceptable for the commune.
For the greater good?
For the greater good. No, for a community, okay, and also for the individual. What's moral for the individual and what's useful for the community is that when thou shalt not have profits, okay, and transfer the risk to others. You should share the risk. You want the profits, you got to take a portion of the risk.
You call this the Bob Rubin Trade?
No, the Bob Rubin Trade is after a person who made. Of course,
the former Secretary of the Treasury.
Yes. He made $120 million in compensation from Citibank over 10 years, selling out of the money option, things that explode rarely, okay, what we call tail risk. And heads he wins, and when the thing happened, Citibank was insolvent.
Goes to 97 cents a share.
Exactly, and then he said, oh, black swan, and then someone else is bearing the cost. The shareholder and the taxpayer stopping him out on a trade.
So he was not alone, of course.
Of course,
but you use him as an example because he's emblematic of the problem?
Exactly. It's that generation of people who think that society owes them profits, but they don't want to bear the risk.
Why is it that Wall Street still has what you claim and argue persuasively is a misconception or a misattribution, if you will, about the notion of skin in the game?
Yeah, because they don't understand three things. Number one, that skin in the game is not just incentives. Two, that disincentives are there for a reason. Since the beginning of times, for 4,000 years, beginning of civilization, we have had rules that don't allow the architect to build a structure and then walk away if it collapses and kills people. So you have
one of the laws of Hammurabi.
Hammurabi, okay.
Back in Babylon.
Exactly. And the third one is skin in the game is a filter. It's an evolutionary mechanism. If you don't have very dangerous drivers on the road, it's because they own their own risk. They die in an accident. They're likely to die in an accident. If you have a bad driver, not likely to die in an accident and not likely to be penalized, you've got a problem.
So let's get practical, Nassim.
Yes.
How do we make the financial system more Darwinian, if you will?
It is working on, by itself, and let me explain. Hedge funds, most of the risks has migrated to hedge funds or structures like hedge funds. In a hedge fund, typically, investors require that the owner or the owners have more than, or something equivalent, 50% of their net worth in the fund. Not just their non-reinvested profits, reinvested profits. It's their net worth. Why? To prevent them from playing the Bob Rubin trade.
Because if the fund loses money, they suffer as well.
They suffer as well, and clawback is not sufficient. You need the person to have. It's sort of like you need someone who cooks the food to taste it, just in case it's poisoned.
But there are still, let's talk about hedge funds for a moment, though, because there are still asymmetrical qualities to the way hedge funds are structured.
Yes.
In other words, if the hedge fund makes money, I, as the investor, make money.
Yes.
But the hedge fund itself gets to keep a management fee, a share of the profits.
Yes.
And the trader gets paid a percentage of those profits.
Yes.
If the hedge fund subsequently loses money, it's not like the hedge fund gives me money back. And it's not like the trader surrenders money to the hedge fund or to the client.
Many hedge funds have clawbacks, and then consider the other situation where the hedge fund loses money, then they got to wait to recover.
Back to the high water mark.
Exactly. So there are things, but the essential attribute, the risk attribute, is handled by forcing the person to eat his or her own cooking.
Okay, so the argument you make is that the risk has been transferred from previously banks, proprietary trading desks, to hedge fund, but that's only really in the securities business.
Yes.
Banks are still in the business of making loans.
Exactly. The problem,
and as many bankers have said, there's nothing riskier you can do than make a loan.
Yeah, Citibank, the current chairperson of Citibank, the successor, now is making what, $20-some million in bonuses? One of those banks, okay, I don't know if it's Citibank, doesn't make a difference, okay? So we're still in a situation where you have what is called rent seeking. People benefiting, taking advantage of that situation and misunderstanding of symmetry.
So I want to, if I may, borrow a quote from the book.
Yes.
You say, quote, Our message is to focus on those who are professionally slanted, causing harm without being accountable to it by the very structure of their own occupation.
Yes. Most 99% of people you see are calibrated. They don't harm, you see the idea, they don't inflict more harm on society than they take. Drivers are calibrated, butchers are calibrated.
Airline pilots?
Everything. They're on a plane. Most people, except for policymakers, people in the profession that we are rebelling against. In Italy, they're rebelling against these bureaucrats. They have absolutely no penalty if they encourage the government to attack, the European government to attack some things. They encourage.
That's why
change in
the
Libya.
League and,
Exactly.
and the Five-Star
Exactly.
Movement made the gains in yesterday's election?
People are detecting. I know from the mail I'm getting, particularly from Italy, right? So people understand that you have a class of people who are not accountable. If you live in a community, if you live in a community, you have skin in the game in the sense that you live with the consequences of your decision. If you're sitting in an office with a spreadsheet, no.
So some Europeans
Yes.
are freaking out about the Italian election result. What do you think?
A whole class. We have to worry not just about Europe, the United States, a whole class. Now people are going after the pseudo-expert. The Black Swan started with the pseudo-expert. There's a whole class of people who pass for experts and they're not penalized because they have no contact with reality, they got no P&L of their own, and they're not penalized when they make a mistake. Someone else pays the cost. People are detecting it.
Would you call then the Italian election result a favorable one?
Well, I think that any consciousness of the problem is a first step towards a remedy. Whatever the remedy may be here or there, whatever it is. In America, the consciousness is a problem, except for a certain class of people and bureaucrats and academics. Most Americans are calibrated, and they're fed up with these pseudo-experts.
So that's what put Donald Trump in office,
Donald
for
Trump won
example?
on that. Someone else could have won the election. It can be go left or right. The idea that you cannot fool people forever. And there is a class of economists, for example. They have absolutely no clue about the economy. They're judged by one another. And the book offers methods. You can guess if an industry is calibrated, like the restaurant industry. The restaurants are not judged by restaurant owners. They're judged by their clients. Okay? Things that are not judged by their constituents, they eventually rot, fields.
I want to take these ideas, these concepts that you explore in the book and bring it back to the very business you started your career in, options trading.
Yes.
In recent weeks, we saw an explosion in the VIX.
Exactly.
And a lot of people lost a lot of money.
Yes.
What are the lessons to be learned
Okay,
from
well,
that experience?
that's the story of my life. You're telling me the story of my life. The problem is they don't understand that this concept that I wrote about in dynamic hedging. Okay, you discover it very, very, very early on as a trader. Never cross a river if it's on average 4 feet deep. So what happened is that they were right, they measure volatility, not realizing that they may blow up being short volatility. So, and these indices, okay, were right in their concept. Hey, if the VIX is overvalued, yes, it is overvalued, but all you need.
Meaning a VIX under 10 shouldn't, or 7 or 8,
whatever
whatever
it is.
it was.
No. The VIX is overvalued, so you short the VIX, you make
Right.
the difference between the VIX but they didn't get that the idea that the VIX is overvalued, okay, doesn't necessarily imply you can make money shorting it. You see, you can effectively, they were right and blown up. This is what I called in the old days the Niederhofer trade. He was right on the market and always bust.
So how do you extend that principle to financial markets going forward? What do people need to keep in mind?
They have to understand nonlinearity. You have to have fewer finance professors, fewer of these bad models involved, learn from old traders, learn from traders who survived, people who have gray hair, I'm talking like myself. They know these tricks. The minute there's a little bit of education is very destructive.
You say as well in the book, no individual can get the same return as the market unless he has infinite pockets and no uncle points.
That's exactly. This is something you know when you trade.
Well, it says here on ETFs, but
Yeah.
that's because I think that this is effectively an argument for being a passive investor. Unless you're prepared to accept.
It's the idea to be more conservative than you think you should be, and you should have a protection if you have exposure, some kind of insurance. If you have an exposure, if the market going down 30% harms you to the point, okay, of threatening your financial health, complete financial health, and maybe bankrupting you or something like that, then you need protection.
Nassim, one thing keeps coming through for me in every one of our conversations.
Yes.
And it's almost as if nobody has learned anything.
No.
Have we learned anything?
No, you only learn via survival. There's one thing about I just noted, I think in an article summarizing the book, I said the following. Restaurants don't improve because restaurant owners learn. Restaurants improve from bankruptcy to bankruptcy, okay? You see? So it's the same thing in the ecology of markets. You only learn via survival. Those people have not been exposed to the threat of bankruptcy, of a P&L, of a real P&L, will never learn because they're not harmed by it.
The way it used to be, say, when Goldman Sachs was a partnership.
When Goldman Sachs was a partnership, they understood markets. Today, their incentive is to not understand markets. Okay.
Nassim, I'm afraid we have to leave it there.
Much. Thanks.
Such a pleasure.
My favorite interviewer.
Oh, please.
Thanks.